Welcome everyone to our Fed Focus webinar. I'll be speaking to Wayne Bishop today to understand what will be driving US markets this year. Wayne will be discussing monetary policy and politics in the United States ahead of tomorrow's Fed September policy meeting. Wayne has over 24 years of experience in the financial services and is now Director of Ethical Investment at King & Shapton, where he and his team are now responsible for 58 million of ethical AUM. Firstly, thank you for joining us today, Wayne.
Thank you.
So let's begin and we'll move straight on to the Fed's balance sheet. So in 2008, the Federal Reserve began a large-scale purchase of assets as part of their stimulus package to try and steer the US economy out of recession. This went on for 6 years and resulted in the Fed's balance sheet ballooning in size. Now questions have been raised as to when they will begin to unwind these purchases. So firstly, Wayne, how big is the Fed's balance sheet and what effect did it have on the US economy?
Well, the Federal Reserve balance sheet today is $4.5 trillion. To put this in perspective, before the crisis began, it was less than $1 billion. But as you can see from the graph here, in 2008 we saw it suddenly rise to $2 trillion, then slowly drift higher before another program of QE started, and it rose very sharply to $4.5 trillion, where it has remained for a few years. Really, after a taper tantrum when they started the process of no longer buying any bonds, we've seen it level out. Why is it important? Well, had the Fed not intervened in 2008 and later on, most people think we would have seen a very severe recession or in fact even a depression. So history will judge this, but we expect history to say this action saved the US economy. The fact of the matter is now it is no longer needed.
Okay, so like I said, we've known for some time about the size of the balance sheet, so why is it significant this year?
I think really now the US economy is venturing back into a period of normality, and with a change of politics, people are looking as to whether or not all this stimulus is now beginning to crowd out real investment. Economic purists, for example, would have never liked this stimulus. They would have always felt this was bad for the economy, it crowds out real money. Now it is becoming a little bit more of a problem. The US economy is beginning to grow, and the fact of the matter is all this money in the system, should the velocity of money increase, which has been the problem that we've had with inflation in the US has not necessarily been how much money there is, but how the money is running around the system. And that's what they call the velocity of money. And inflation is the velocity of money times the quantity of money. Now, if the velocity of money starts to increase because we are seeing a better banking system and the velocity of money increase, with all that supply of money out there, that could become quite inflationary. So now you want to look at starting to gently reduce that supply of money. That's the economic purist argument. But I think more than anything else, it's a sign of normality. It's a sign that we're returning to normal and that balance sheet can return to normal.
Okay, so we're expecting comments tomorrow regarding the balance sheet. Do you think the Fed have communicated their plans appropriately to investors? And is there any reason why they should be nervous?
Absolutely. I think the Fed have been absolute masters of communication. It should come as no surprise to anybody that they're going to start to slowly withdraw or no longer purchase any new assets and so begin a very slow and steady pace of deflation. Anything that deviates from this very slow and steady pace will of course be a shock to the market, but I genuinely don't think that they're going to do anything to surprise anyone. I think we pretty much know the content of tomorrow's meeting.
So it's slow and steady. Yeah. So it's been reported that the QE programme lowered the 10-year Treasury yield by 1%. Are we likely to see something happen, obviously, in the reverse, or what else can we expect to see?
Yes and no. Long term, we do hope Treasury yields rise because obviously we hope to see a stronger economy, and as we return to normality, we want to see a more normal and perhaps slightly steeper yield curve. But I think because this has, one, been incredibly well flagged, and two, because I still think there's still strong demand for US paper, I don't see it having an immediate effect. So I think short term there should be no effect. Long term, we want there to be an effect.
Okay, so we've seen, moving away from the balance sheet, we've seen 2 rate hikes from the Federal Reserve this year, which leaves the benchmark interest rate between a range of 1% and 1.25%. A lack of price pressures has been a real headache for the Federal Reserve this year. However, we did see inflation rise to 1.9% last week. Are we truly seeing underlying pressures building?
I think eventually there will start to be some underlying pressures built, particularly maybe in the area of wages. As people start to get a little bit more confident, I think we will see some lower level wage pressure. And I think some of the some of the way that the government is spending money is going to be inflationary as well. So yes, I think that you are seeing a build-up of pressure. And I think as confidence increases, and provided the banking sector continues to lend money, then I think you should see an increase in inflationary pressures.
Okay, so we've had comments about the lowly inflation levels this year, and we've seen a trend. We've had the likes of Robert Kaplan and Bill Dudley comment that longer-term structural forces may be holding inflation back. Based on this, can we expect another rate hike from the Fed this year?
That's a tough one. The jury really is out on December. I think they're right about the structural issues. I'll give you one very quick example. What about oil? You know, oil has been falling in price. That has been a real brake on inflation. Obviously, what's happened with the hurricane season has already impacted the gasoline prices. So that's kind of where you would expect to see inflation build up. Will there be an increase in rates this year? I think a lot comes down to two things. On the negative side, you've got the effects of the hurricane dragging the economy down, which some people might say may cause the Fed to hold back fire a little bit. On the other side, you've still got potential changes in the tax rate and potential sort of new budgets coming out before December from the Fed Reserve. So really, this is out of the hands of the traditional markets. It's not so much a monetary decision. I think a lot of it will come down to what kind of fiscal decisions we see coming out between now and December. And I think that will determine whether or not we do see a rate hike.
Okay, so when the Fed do start tightening policy further in terms of hiking interest rates, how much further can they go?
Well, I think most of the market seems to be anticipating that sort of by the end of 2018 we're sort of around the 1.75 level, and that we should be hitting in sort of late 2020 is when we're going to hit the 2%. I feel the market's perhaps aiming a little bit low there, if I'm honest to you. I think there may be a little bit more next year than people expect. But again, we're at the mercy of the politicians here, I'm afraid to say. It very much depends on what we get out of Capitol Hill next year in terms of budgets and what kind of effect they're going to have on inflation expectations. So I feel the market's perhaps slightly underestimating the sort of 1 to 2 year part of the curve at the moment.
Okay, so you mentioned about Capitol Hill, and that obviously brings about Donald Trump. Mm-hmm. What impact do you think he's had on the Fed's plans to normalise policy?
I think you felt from the election there was a lot of pressure to normalise and get rates going. Whether the Fed have bowed to that, I don't think so. I think that was actually the natural trajectory anyway. So perhaps we should have flattered the politicians with this process. I think it was already in place. It really comes down to taxation and budget, which are the two great ethers out there at the moment. No one really knows what's going on. All we do know is that there is something going on. We know there is a lot going on in the back rooms. And I'm one of those people who generally do think something will happen this year. We will see something on tax and we will see something on the budget. And therefore, we should see hopefully some kind of fiscal stimulus coming in. But politics is politics.
Yeah, so you were mentioning there about, obviously since the election there was the Trump trade, and we've seen a lot of that being unwound recently. So do you think investors are being premature?
Yes, I think we were over-optimistic at the start. We swung too much one way, the pendulum has swung back too far the other way now. Got to remember, politics is a people's business and it is very messy. And really, although there are two parties in the US, a little bit like the UK, really there's a lot of factions underneath. And there is an awful lot of log rolling and difficult wrangling going on behind the scenes. So I do feel markets have gone from expecting too much to too little. And I do genuinely think that there is a lot of pressure for the Republicans to have something to show before next year's midterm elections. And really they will want to wrap this up before Christmas. So therefore, I do feel there's a lot of pressure to get something. It will not be to everyone's liking, but it will be something tangible that they can then push back and show to the electorate.
Okay, so the US debt ceiling was extended to the 15th of December. So arguably that's just kicked the can down the road a bit. So first of all, what is the debt ceiling and is it likely to be a big issue?
Well, the debt ceiling is an absolute limit that the US Treasury can borrow, and it was raised slightly because of the hurricane, so it's just over $20 trillion at the moment. And it is an absolute limit. If they get there, they cannot lend any more money. They cannot even then start paying interest if it takes it over that limit. So it is extremely important. It has led to a number of crises in the past. 2013 in particular, 2012, and I think is a very political issue. I believe it will form part of what is going to go on with the whole budget and tax politics. I think there is a whole package of things going on at the moment. So I do expect it to rear its head again in December and be an issue, unless by then we have a complete solution. I think the problem is you've got the budget issue, you've got taxation, and you've got the debt limit. And I think that what's happening here that is perhaps slightly different is they're trying to do all three things at once instead of one thing at a time in a bite-sized way. You've got Trump trying to solve three problems with one slam with the hammer here. And I genuinely think he'll pull it off, but if he hasn't pulled it off by December, things could get quite frightening again.
Okay, so Donald Trump, during his election campaign, attacked Fed Chair Janet Yellen, and we haven't seen any of that since he's been inaugurated. But Janet Yellen's term will expire in February. What significance does this have?
This is extremely important. Obviously, the chair of the Federal Reserve Committee is extremely important, and she or he will determine the course of American policy. Ben Bernanke brought a big change, Janet Yellen brought a big change. So yes, whoever's in the driving seat is going to be very important. So we now have the issue of who's it going to be. Obviously, for a long time, the market was expecting Janet to be replaced, and Gary Cohn was the favourite. Obviously, since recent incidents in America, Gary Cohn has kind of fallen out of favour, and expectations have gone back to maybe seeing Janet stay in the job for another term. Yes, Donald Trump has changed his tone towards her, and I think actually she is doing a good job because she's having to manage an extremely difficult transitional period. Given that this is a very difficult period, there was some wisdom in keeping her, even if he doesn't like her, just have one less change. Also, bear in mind that Janet Yellen is not the only change. Obviously, we had the resignation of Fisher, and we do have some other regional boards coming up, so there is actually quite a lot of change that is likely to happen in the Fed. So people, and Fed watchers in particular, are going to be paying a lot of interest in who gets on the committees. So watch this space.
Okay, thank you very much, Wayne. That's all for today, so thank you for joining us for this webinar, and we look forward to seeing you at another one very soon.